Institutional investors increasingly ask the same question. Can digital assets generate yield beyond price appreciation? The answer is yes, but the methods, risks, and appropriate position sizes vary enormously. The crypto lending ecosystem spans a spectrum from centralized custodial platforms, where you lend assets to a counterparty in exchange for a fixed or variable rate, to fully decentralized on-chain protocols where smart contracts autonomously match borrowers and lenders. In 2024, institutional crypto lending generated approximately $0.2 billion in yield across both categories. Understanding the mechanisms, risks, and appropriate allocation frameworks for each is essential before any institution commits capital to yield-bearing crypto strategies. 3 distinct mechanisms generate yield on crypto assets, and confusing them is a category error that leads to poor risk management. CeFi lending involves depositing assets with a regulated or semi-regulated platform that on-lends them to institutional borrowers, hedge funds, market makers, and trading firms that need crypto liquidity. Your yield comes from the borrower paying interest. Your risk is the platform's credit quality and operational integrity. DeFi lending uses smart contracts to match supply and demand automatically. You deposit assets into a protocol, and borrowers take over-collateralized loans against different assets. Rates adjust algorithmically based on utilization. Your risk is smart contract code, oracle manipulation, and governance attacks, not a human counterparty. Proof-of-stake yield is categorically different from both. You are participating in network consensus and earning protocol inflation plus transaction fees. There is no borrower and no lending relationship. You are a validator. The 2022 crypto lending crisis exposed the critical difference between CeFi and DeFi lending in terms of transparency and systemic risk. Celsius, BlockFi, and Genesis, 3 of the largest CeFi lending platforms, all collapsed within months of each other, resulting in billions of dollars in institutional losses. The common thread was opacity. These platforms were rehypothecating depositor assets, taking leveraged positions, and in some cases operating what amounted to Ponzi dynamics without public disclosure. In contrast, every major DeFi lending protocol survived the 2022 market crisis without a single protocol-level loss. Aave, Compound, and Maker, all fully on-chain and auditable, liquidated under-collateralized positions automatically as prices fell, maintaining solvency throughout. The on-chain transparency that seemed like a disadvantage became a critical safety mechanism. Institutions could verify protocol health in real time. CeFi depositors had no visibility until it was too late. No yield in crypto is risk-free, and the risk profile of each mechanism is distinct enough to require separate underwriting frameworks. For CeFi lending, institutional due diligence must include, at minimum, proof of reserves audits, counterparty credit analysis, regulatory licensing verification, and insurance coverage review. The 2022 collapses happened to sophisticated institutional investors who skipped these steps because yields were attractive and counterparties seemed large. For DeFi, smart contract risk is the primary concern. Every protocol should have a multi-year audit history from multiple independent firms, an active bug bounty program, and a conservative governance track record. Concentration limits apply. No single protocol should represent more than a defined percentage of total crypto yield allocation. Staking yield, while structurally different, carries slashing risk. Validators can lose a portion of their stake capital for protocol violations, and liquid staking protocols carry their own smart contract and depeg risks. Building a crypto yield allocation that survives market stress requires the same rigor as any fixed income credit strategy, with additional protocol-specific due diligence layers. Start by defining risk buckets. CeFi lending is a credit risk strategy. You are underwriting a borrower. DeFi lending is a technology risk strategy. You are underwriting code. Staking is a network participation strategy. You are underwriting a consensus mechanism. These are not interchangeable risk factors, and they should not share a single allocation bucket. 4 CeFi counterparties require the same documentation you would from any credit borrower: audited financials, insurance schedules, operational risk assessments, and contractual limitations on rehypothecation. The platforms that failed in 2022 would not have survived this due diligence process. For DeFi protocols, on-chain data provides transparency that CeFi cannot match. TVL trends, utilization rates, governance proposal histories, and audit reports are all publicly verifiable. Use them. The institutional crypto lending landscape in 2026 is meaningfully more mature than in 2021 or 2022. Regulated platforms now offer proof of reserves as a baseline expectation. Institutional-grade DeFi interfaces provide compliance tooling, transaction monitoring, and reporting that TradFi operations teams can integrate. Staking yields on Ethereum have stabilized around 3 to 4%, not exciting relative to traditional fixed income at current rates, but offering true portfolio diversification since POS yield is uncorrelated with credit cycles. The frameworks for institutional participation exist. The question is whether the yield justifies the operational complexity and residual risk. For most institutions, a modest allocation, calibrated carefully across the three mechanisms, provides meaningful diversification from traditional yield sources without betting the farm on any single counterparty or smart contract.